Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going out there? It's February 12th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Today's going to be a very special podcast. No, I'm not going to have any rants that piss off a small percent of my audience. And I'm not going to have a guest today. I'm not going to have a guest because the research that I did on a topic that you're going to hear in a minute just consumed my whole entire life, pretty much the past 2 to 3 weeks. It's one of those things where you find stuff and you just keep digging and digging and digging. And what I found is really crazy. So it's all me today. You're stuck listening just to me, no guests. And I hope you stay tuned for the whole podcast because it may be one of the most important podcasts that you'll ever hear from me. And I'm not building this up. You're going to see in a second. Now, if you've been following my work over the years, you know I'm quick to call bullshit on most crazy market calls. I told you to ignore the crazy, insane perma bears for how many years, calling for a 50% plus crash every single year, at least 4, I would say the past 6, 7 years, maybe. I said to stay long stocks through Brexit, numerous government shutdowns we've had over the past few years. I told you to ignore every negative story about the U.S. and China trade war. That this is a China problem, not a U.S. problem. Stay long stocks. A lot of criticism for that. I'm glad, hopefully, that you guys listen. And I'm not highlighting these calls to be arrogant. You guys know I cover my losers. I don't need a confidence boost because I'm insecure. I need to talk positive about myself all the time. No, it's not about that. These calls that I made in the past, I spent tons of hours researching, analyzed hundreds of reports, talked to industry experts, people that are in my Rolodex that I built up over 25 years. Write up my research. This way you could draw your own conclusions instead of listening to the crazy talking heads on TV that have an agenda. But at the end of the day, my research isn't based on stubbornness or emotions, so sometimes that offends people. But it is based on data and a lot of hard work. And right now, my research shows that the coronavirus risk is nowhere near being priced into this market. And if conditions worsen, we could be in for a lot of hurt. And I'm not just talking about China. I'm talking about the global markets. And I know what you're thinking. I just put on CNBC today. Las Vegas Sands had the most exposure to coronavirus. They got upgraded because the numbers are coming down. Ignore the talking heads. When I look at the coronavirus, it's very, very, very serious. And the numbers I'm going to share with you today, it's going to be hard to disagree. Numbers that you're not hearing anyplace else. I mean, for the thing to be dying down and CNBC to do a special on this yesterday, which I didn't see yet. I didn't need to see because I know more than what they're talking about. That's how much I researched this thing. Went through tons and tons and tons of research reports. Talked to so many different people. Again, just so engulfed with this that when it came Tuesday, I forgot that my podcast was Wednesday. And I love getting lost in my research like that. Now, if you're on another planet, let me just break down the coronavirus. Because it happened around, the alarm got sound pretty much in late December. So doctors identified around 40 cases around the Wuhan area. They noticed most of the infected people worked at a seafood wholesale market in Wuhan. So authorities immediately shut that down. That was around January 1st, just to contain, and they call it mystery illness. But 1 week later, doctors confirmed the existence of a new virus, one that they've never seen before. It's actually a new strain from a family known, as coronaviruses. So this isn't really a calling to coronavirus. It's really called COVID-19, but the coronavirus was also SARS, right? And that's what everyone's comparing this to. So SARS appeared in 2003. Again, that was a coronavirus, family of coronaviruses. That was an outbreak in China. China really got that wrong. I'll go over that in a minute. If you're looking at MERS, if you heard of Middle East Respiratory Syndrome, that popped up in Middle East. That was in Saudi Arabia. That was in 2012. These are all coronaviruses. Now, at first, the symptoms are pretty similar to a cold. Most patients get a fever, runny nose, dry cough, a little stuffy. About 15%, these are the worst cases, they'll develop into severe pneumonia. And right now, there's a 2% fatality rate. So if you're looking at this virus, just like the flu, it can't be treated with antibiotics. It's also very highly contagious, as you probably know. I mean, it's spreading like crazy. But it spreads through the air when an infected person either coughs, sneezes, through a simple handshake. And to protect yourself, experts are saying, hey, wear a mask, wash your hands often. Masks do not work, guys. And if you're a doctor and you have your hands covered, it's different. But these people are going to go back to work with masks on, and they don't have gloves on. They're touching different things. When you take the mask off, you almost touch your mouth. They don't help. I mean, if you talk to the best doctors in infectious diseases, they're going to tell you masks don't help. They really don't for the majority of people. But yeah, that's okay. Everyone's going to wear a mask, and they're going to say, okay, you can go back to work, and they're letting people slightly go back to work a little bit. I'll get to that in a minute. Now, to compare the SARS outbreak, which is huge, a huge news story, huge, right? Because massive panic 2003 spread to 17 countries, infected over 8,000 people over a 9-month period. Meanwhile, this coronavirus infected the same number of people in less than 2 months. And it's now spread to all of China's 31 provinces. And we know it's not just a China problem, right? Cases have been reported over 24 other countries. I won't name them. Not a big deal. Most of those cases are very small. About 98% of the cases are still in China, but there is a chance for this to spread. Now, what has China done differently this time compared to SARS? Well, SARS, they didn't really isolate people, right? They didn't have containment, a little bit of containment, not as much, very, very small. But we saw over the past couple of weeks that the number of confirmed cases exploded higher, right? So we talk about around January 20th, and it's February 12th today, there was a couple hundred confirmed cases. By February 10th, 2 days ago, that number soared over 40,000. Now, again, I'm not worried about the coronavirus spreading much outside China. I mean, early estimates indicate that the virus reproduction rate is around 22.5. That means for every one person infected, about another 2 to 2.5 people will end up catching the virus. So that's an important measure, not that you have to write it down, but that's how they measure how contagious a disease is. And they want that number to fall below 1 before they say we have control of it, which is not even close. So China's response was, hey, you know what? Let's completely cordon off the infected regions. We'll isolate everybody from the rest of the world. This includes closing factories, stores, and streets in more than 20 of those 31 provinces, which represent more than 75% of the country's global output, right? They closed everything. That's what they decided. Mandated it. The economic consequences of this decision are significant. They're being significantly understated. And it's not just for China, because I said when it comes to the coronavirus, there's two different things here, guys, that you have to understand. I'm not sounding an alarm like you have to stay inside and you're going to get, this is kind of like the flu. But the flu, how many, 20, 30, 40 million people get every single year? Depends what estimates you look at. I did a lot of research on that. And, nobody's closing anything because of it. But they decided to close everything and isolate everybody. Okay? Now, extreme times call for extreme measures, I guess. Because on the week of February 3rd, thousands of companies announced they're going to temporarily suspend operations, which included corporate offices, manufacturing facilities, retail stores all across China. Meantime, that's what they said, but China was mandating the government, right? So most were scheduled to reopen on February 9th, but the data has been pushed as the coronavirus is no longer showing signs of slowing. Now, they say people at Foxconn, I'll get to that in a minute, are going back. A few of them are going back to work, but most of them have not opened up as of right now. So people say, well, it's slowing a little bit. And I'm going to tell you why that it's slowing. I mean, I'll tell you why right now. I mean, China's great. One is don't believe those numbers. But the biggest reason is China decided to classify these people. So if you're infected and not showing symptoms, you're not included in the infected. Think about that for a minute. So I could test positive for the coronavirus, and maybe I don't show symptoms. Maybe my immune system is just, okay against this disease, whatever it is. But I could transmit it to anybody. But yeah, I'm not part of that, whatever it is now, 43, 45,000, whatever that number is. They don't include that. Very interesting. So getting back to the stores, Apple said it's going to close all 42 of its China stores. They have 2 major plants in Foxconn, one in Shenzhen, another in Shenzhou. Those are the world's biggest iPhone production bases. Shut down. McDonald's closed 300 plus stores. Starbucks closed over 2,000 of its stores. Yum China closed over 3,000 of its stores. Nike closed half its stores. H&M closed 97 stores. IKEA closed all of its 30 mega stores. Levi's, who just went all in on China, opened up a massive facility, 7,000 square feet, shut down. You had Wynn, Las Vegas Sands, MGM, Melco Resorts and Entertainment. They closed their casinos in Macau. There's 41 in total in Macau. I told you, I've been digging, doing all the numbers, research on this. Macau shut down. If you're not familiar with Macau, I've been there. Largest gaming city in the world, generating more than twice the sales in Las Vegas. That's how big Macau is. Only place in China you can gamble. Manufacturing giants. You have Siemens, Lenovo, Huawei, Honda, Toyota, Renault, Tesla, General Motors, Ericsson, LG, all close their stores. Most major airlines also suspended flights to China. Even Disney. Disney closed its theme parks in Shanghai and Hong Kong. To put that in perspective, yes, I did research on it. Disney closed its U.S. theme parks only 7 times in its history since 1971. Almost every closure was due to weather. It was for about a day. The lone exception being the days following 9/11. Yet they closed both those parks. Dozens of cities in China are now quarantined. And buses, trains, flights, and ferries, they're suspended. The streets are empty. Even today, they're empty. No matter what they're telling you, they're empty. And I mean, whatever they're telling you, it's slowing. It's not, fewer people. It's not going as fast. The infection rate's coming down. Again, don't believe it. But if you're in China, different area, quarantine, it's nobody can travel to those provinces, and it's close to impossible to leave. So this amounts to 400 million people on lockdown. And most of the cities have populations greater than New York City. Today, they look like ghost towns. Think about that for a minute. 400 million people. That's more than our population in the United States. Imagine that you are quarantined, and it's about a week, a little bit over a week now, that you can't leave your house. I mean, think about what's going to happen to the economy. I mean, nobody's going to work. Much less electricity is being used. You're not using fuel because you're not driving any place. You're not doing anything. Sit in your house, and we'll have a couple of companies deliver food for you. And maybe we'll keep a couple of stores open, which a couple of food stores they did keep open. But 400 million people on lockdown, right? 400 million. This is the largest quarantine in mankind, right? History recorded. China almost completely isolated itself from the rest of the world. And I guess extreme times call for extreme measures. But just how extreme is the outbreak? Because as of February 10th, the Chinese government said 40,000 people are infected. And 900 of those cases were fatal. It's a little bit higher now, I know. Just using those February 10th numbers 2 days ago. Now, if you believe those numbers, right, which the whole market does, right, we're at all-time high. If you really, truly believe those numbers, the infection rate in China amounts to 0.0028% of China's entire population. When you look at the fatality rate, more people in China die from being struck by lightning every year compared to how many people die from this virus. Yes, I looked that up. So that leads us to the $64,000 question. If only 0.0028% of the people living in China are infected, then why mandate tons of store closures, station military police to block train stations, and keep over 400 million people on lockdown? You know why? Because the government's lying to you. And I'm not the only one that thinks this. The Lancet published a model suggesting, and this is from January 31st, at least 75,000 people are infected with the coronavirus in Wuhan alone, more than 10 times higher than the cases that were currently reported. Lancet is not some sleazy tabloid. It's one of the oldest, most prestigious medical journals in the world. On February 5th, Tencent, one of China's largest companies, accidentally published a report with up-to-date statistics. They said that 154,000 people were infected, and this is more shocking, 24,589 people declared dead. That same day, the Chinese government said, no, there's only 28,000 people infected, and only 565 people have died. 565, the government reported. Tencent put it on their website. 24,589 people were dead. Compared again, just 565. So Tencent's death total was 40 times greater than the numbers being reported by China's government. Of course, after a couple of hours, it was removed. But guys, this isn't some crazy conspiracy theory. I mean, Tencent has a market cap close to $500 billion. Put that in perspective, it put in the top 10 companies in America right now. It owns WeChat, right, the messaging service, over 1 billion users in China, and it's the largest gaming platform and also the music service company in the world. They own those two industries. We're talking about, I mean, the reach to their consumers. There's not a better company. I mean, these guys have more reach than Amazon does in America. I mean, if you're looking at Tencent, they have more access to Chinese consumers than any other company in the world. On February 6th, Professor Neil Ferguson, director of the MRC Center for Global Infectious Disease Analysis, that's at Imperial College in London, he claimed that 50,000 new cases of coronavirus are emerging in China every day. 50,000 a day. More than 15 times higher than the 3,000 cases the government is reporting. He even says a true scale of coronavirus isn't being reported by Chinese officials. Neil Ferguson is a big shot. His job is to determine the spread of infectious diseases using mathematical models and strategies. That's what he's done for his whole entire career. There's no bias there. He's not trying to get attention. So as I mentioned earlier, the virus, based on the numbers I look at, showing no signs of slowing. And they said this about 3-4 days ago, that, hey, it's slow. Then all of a sudden, cases went back up again. It's getting to the point where that line has become linear. It's moving higher in a straight line. But for some reason, everyone's like, oh, it's, the infections are slowing. We're okay. But based on this data, the coronavirus is nowhere close to being contained. Yet the markets, including China equities, rebounded sharply as if the worst is behind us. And I have to tell you, this disconnect is not going to last long. And when the tide turns, a lot of investors are going to be crushed. They become the wrong side of the fence. I'm not one to sound the alarm. I haven't been bearish. I've been cautious at several times. That was before China or Trump's decided to issue the tax reforms. I was like, well, the market sees a lot of then the tax reforms came out. I said, well, that puts a whole nother level on being bullish. Been bullish for a very, very long time overall, if you read my newsletters. This has been the first time in a very, very, very long time, probably over 10 years, where I'm looking at the market and it's not making sense, okay? I'm going to break down even further because you're probably like, yeah, on the fence, I don't know, Frank. Listen, just keep listening. Because you have most investment firms, they're downplaying this risk. Goldman Sachs pointed out that during the most recent disease epidemics, growth rates weakened and then rebounded sharply in the following quarter. And they used everything, the swine flu, MERS, SARS, compared to everything. JP Morgan rated the same points with investors. Say, hey, buy China equities on a pullback, right? And what happened now? Well, if you're looking at the markets today, there's news saying the coronavirus slows, and you had Wynn just got upgraded from Bank of America. That's trading about 10% off its 52-week high. Las Vegas Sands, these are the companies that have the most exposure to China. Las Vegas Sands, Las Vegas and Wynn have huge operations in Macau, so they generate most of their revenue. They got upgraded. They're close to a 12-year high. UBS upgraded Micron, who has a ton of exposure. They upgraded Micron. It says, the time has come for material outperformance, right? That's what UBS says. By the way, the stock's up 41% over the past 12 months. It's at a 20-year high. Now's the time? No. 12 months from now, or 12 months before this was the time. That's when you should upgrade. So now's the time. Now, that's like me putting out a report. Now's the time. Amazon's going to take off. Give me a break. Interesting. Everything's okay. Now, I study sell-side analysis. Some of these guys are really good. They actually had some really good statistics that I read. I read almost every single report from every single brokerage firm. And when you're looking at the data, that makes sense. You know why? Because sell-side firms use history as a guide, like we're always told. And it's going to fly in the face of everybody and all the greatest investors and books you read. It's going to fly right in the face because everybody says history repeats itself. It doesn't all the time. Whenever people say all the time, always, never, run. Okay? I mean, if that's the case, that's why none of these investment banks saw the housing crisis coming in 2007. You know why? After all, history shows us that housing prices always move higher. Yet they almost destroyed the entire financial system. Yeah, I'm not discounting the importance of historical analysis. I use it, but it's not the end all. Okay, it's this way or no way. But comparing the coronavirus to past disease epidemics is absolutely ludicrous. It's like comparing today's times, and this is why even some of the great analysts have got it wrong, because they're comparing today to other times. And you can't compare when interest rates are zero or close to zero. They're a little bit above 1%. You can't, with interest rates so low, with favorable monetary policy, not just here, all over the world, with these buybacks coming, it's a different market today than we've ever seen. And people are comparing and saying, well, the last time this happened. I mean, so many great analysts. The last time it happened, this isn't the last time. We're in a market that's never like this. It's the longest bull market ever. How many people told us it was going to end 3 years, 4 years, 5 years ago, 6 years ago, 7 years ago? Still going. So now what are they doing? They're comparing the outbreak of the coronavirus to SARS. Let's break it down a little bit, because SARS took place over a 9-month span between 2002 and 2003, during which 8,000 people were infected. Now, the coronavirus, COVID-19, I'll call it the coronavirus because it sounds better than me just shouting out a couple letters and a couple of numbers. It's less than 3 months old. Already has more than 40,000 Chinese citizens that are infected, if you believe the government. I think it's much, much more high than that. Only 8 provinces in China were impacted during the SARS outbreak, and there was minor containment measures taken to reduce the spread of the disease. Today, the coronavirus has spread to all 31 provinces in China, and over 400 million people are on lockdown. Before SARS hit in 2020, Chinese residents took 16 million trips outside the country. That's a lot. Again, this is SARS. This is back in 2002. In 2018, because those are the latest statistics available, that number increased tenfold, with 162 million residents in China traveling outside the country. Think about that. It could result in the virus spreading much quicker. But look at China's economy today. In 2003, China was the 6th largest economy in the world, accounted for 4% of global gross domestic product, GDP. Today, China is the 2nd largest economy in the world, which it accounts for close to 17% of the world's GDP, and it's completely shut off right now. But everybody's upgrading stocks. Everybody's acting like, guys, there's something you have to understand. I mean, 17% of the world's production is completely suspended right now. And we're not near containment. We're not near containment. I mean, they're still holding up, Carnival ships. They just docking them. They're not letting them in other countries. We're not even close. This isn't like a light switch. You don't just shut it off, turn it on. Okay, everything's fine. No, what do you care? I mean, SARS, which was 8,000 people, took 9 months. You know how long it's going to take for China to get back to full production? You think it's going to take less than 9 months? You're crazy. Meanwhile, just 1 week after the mandated shutdown, China right now, they're preparing to let citizens return to work. Pretty insane considering the coronavirus takes up to 2 weeks to reveal symptoms. So, again, I'm not sounding alarmed that you have to worry about getting this virus. What I'm sounding alarm on is there's a big difference between the health part and the economic part. And people are not getting the economic part. They just think, oh, this is shut. Nobody's working. Nobody's gone back to work. And what's going to happen? You're letting these people go back to work, and a lot of them are going to affect other people, which is fine. It's kind of like the flu, but they're going to stay home. And you have to realize the sentiment behind this thing. You're scaring the shit out of people. You have to stay home. You're on lockdown. You're on a cruise ship. You're locked in your room for a week. People are deathly afraid of getting this, even though SARS had a 10% fatality rate. This only has a 2%. But you're making it that if you get this, you're like, now people are scared. You think they're going to run back to work. And by the way, most people in China travel hundreds of miles to work. I've been there. You see these massive factories that hold 500, thousands of people, and they ship in, they stay there for 3 months, they have these living quarters, and they go back home to inland China. And a lot of these people travel to work. But everything's fine. You don't have to worry about it. Everything's fine. Everything's really cool. Now, when I look at the numbers, China's economy grew by 6.1% in 2019. That was the slowest pace in 30 years. Now economists are calling for just 5.5% growth in 2020. That ain't happening. And I'm not the only one that thinks so. I mean, you can pull a lot of different economists. Even JP Morgan lowered their estimates recently. They love lowering estimates and upgrading that price targets and stuff like that. They're great for that. Now, Ed Hyman, who is the chairman, head of the economic research team at Evercore. Evercore, guys, I read research reports from the sell side all the time. Evercore, to me, is the best in the industry. Okay. So Ed Hyman has been ranked number 1 by Institutional Investor Poll of Investors for Economics 39 out of the past 44 years. He's predicting China is going to see 0 economic growth in the first quarter as a result of the coronavirus. 0. That's no place. I hope he's wrong. But if that's not enough to make you nervous about being 100% long on stocks right now, especially in the U.S., then maybe this stat will kind of ease that. China, and this is according to the International Monetary Fund, China accounted for 39.2% of the global economic growth in 2019. That's an incredible number. I didn't know that until I started researching it. Think about that. We're in a full-blown growth market in the U.S. Companies are trading, from a valuation perspective, all-time highs, and that's fine. Pedal to the metal, favorable monetary policy, maybe more tax reforms coming. I get it. I understand it. But that's assuming that everything is fine. Now, let's put that number in perspective, okay? Forget about that, the 39% is China. Think about if it was a company. Imagine a supplier generated 39% of its sales from Apple. Then imagine Apple decided not to use a supplier for, say, 6 to 9 months. What do you think would happen to that stock? I know. I've seen it happen. A lot of these stocks fall 20, 30%. And you know what? You see that kind of reaction all the time when a growth company loses a big customer, or if a growth company shows signs of slowing. Maybe they get away with it with a quarter. But if it's 2 quarters, whoa. That's what happened to Microsoft. Microsoft, Apple used to trade at 50, 60, 70 times earnings, and then they came down to 12 times earnings because growth slowed. Now growth picked up again. Now those multiples are a lot higher, up to the 20s. You're only going to have a multiple that's higher than the market at 17x if you're growing. You should. If not, then that's a problem. That's one of the reasons why I don't like Disney. Disney's got 24 times PE, and they're not even going to go earnings year over year. But everybody loves them. 52-week guy, nobody cares. This is different. You're taking the world's growth component out of the market right now, and you're not too sure when it's going to come back. And people are just anticipating. You're comparing this to SARS, which is insane. China was 4% of the economy back then. It's 17% now. There's a major, major disconnect going on. And you know what? A lot of stocks in your portfolio could get hurt in 2020. That's why this is an important podcast, because you should be sitting on pretty nice profits. It's my newsletters or whoever you listen to. Hopefully no one's just telling you to buy gold and go 100% in gold for the last 7-8 years. I do know people like that. But if you're in U.S. stocks, you should be okay. I mean, I'm up 30% last year. Been going up constantly. I mean, last year, a little bit of a, downturn at the end of the year, but 2019 was great. But you're looking at the stock market. Most stocks with exposure to China fell sharply from January 20 through February 3rd. Everybody's worried. Right? This is shortly after the government forced business and factories to temporarily shut down. But most of these names have rebounded sharply over the past week. There's fears of the coronavirus spreading have eased. I mean, very surprising considering some of the largest companies, S&P 500, warned on their quarters. They warned. I listened to these. They warned and said, listen, we may be impacted. Even Microsoft, Apple widened their gap. Ford, which we saw. I mean, a lot of companies said we really don't know yet. We don't know. But To help you guys out, here's a quick breakdown of the S&P 500 sectors with the biggest revenue exposure to China. Be careful, because I'm saying revenue, that's going to change it a little bit. So when it looks at revenue, you look at information technology, just that's 10%. Just throw that with most semiconductors, most large cap technology stocks. You have a communication service, 6.1%, healthcare, 6.8%, materials, 6.6%. Those are the biggest. So if you want no exposure to utilities, it's energy, real estate, REITs in America, financials here too. They have, not as much exposure. They do have exposure, but not as much. Most of them are US based. Consumer staples is right in the middle. But you're looking at information technology, which is, again, most large caps, technology stocks, the semiconductors. I mean, the amount of money, it's like 50% of all the chips within the semiconductor market. And they put a number on it. It's like 450 billion or something like that. Some way or another go through China, whether they're produced there, whether they're shipped through there, whether they're shipped. I mean, that's how much China influences our technology market, how much influence they have. Now, again, if you're looking for safe havens, utilities, energy, real estate, financials, but when I look at those stats, it's misleading. So when I see in information technology, that sector has around 10% of revenue exposed to China. I mean, if you look at individual names, Wynn Resorts, close to 80%. Qualcomm, I mean, all 70%. Las Vegas Sands, Micron, amazing. These companies are being upgraded. They're at 52-week highs. 52-week highs, like everything is fine. This is the revenue from China. Looking at Broadcom's on this list, Advanced Micro Devices, companies that are soaring right now. Skyworks Solutions, NVIDIA, Corning, Western Digital, Apple is around 20%. Corning's around 22%. Texas Instruments around 25%. These companies should be trading. I mean, other than Texas Instruments, I know I had a couple bad quarters. A lot of those technology stocks are trading at all-time highs with crazy valuations, again, which is fine if you're growing. But you just took the biggest growth component in the world and removed it, and it's temporarily shut down, and people are like, well, it's going to come back. Like, it's going to come back full circle. Like, all these people are going to go back to work at the same time. I mean, if the statistics are right in the research that I'm doing, there should be millions of people that are infected right now, easily. And that's okay. It's not like they're going to die. It's a low rate. Again, but there's going to be a ton of people that get infected. They go to work again. In 2 weeks to show up, you're only holding these people for 1 week. Or you hold them even longer for 2 to 3 weeks, and again, you got zero output. Maybe, it steadily goes up. But to think that over the next 2 quarters, this is going to go right back to normal, man, that's pretty insane. That's pretty insane to me. Now, the numbers I showed you are based on revenue, and that's cool. That's fine. But a lot of companies outside this list are extremely dependent on China as their growth engine. That's why they're trading at high multiples. For example, you look at Nike. They're not even on the list of, and I have a list of 25 companies more than 20% of sales. Nike's not even on that list, right? 20% of sales towards China. Yet China accounts for 17% of their total sales. But much more important, which you guys have to understand, is China is its fastest growing region by a mile, where sales surged 21% over the past 12 months. More than half of Nike stores in China are closed right now. That growth component is turned off. Think about if you turned off the growth component in Amazon and Microsoft right now. Say if all their cloud revenue, the reason why they're trading, the reason why Microsoft's up so much, and Amazon, especially over the past 3 years, is cloud. Imagine you said that they're not going to have any revenue for cloud for 6 months. What do you think would happen to those stocks? You're removing their growth component. They would get crushed. I don't care how big they are. They would get crushed. I mean, you could have 75, 80% of your revenue tied to America, but that 20%, if you're in a high growth market and that's steadily growing, that's where you get the growth multiple in stocks. We've seen IBM do better. The multiple is going to go higher and higher because they transition their company. China is a growth engine of so many stocks. And the funny thing is Nike's management team on the conference call, they said in the short term, we expect the situation to have a material impact on our operations in Greater China. Yet Nike stock's trading close to its all-time high. The management team is telling you that this could have a material effect. Look at Starbucks. China is the growth engine for Starbucks. There's a Starbucks 2 on every corner in America. They're growing like crazy in China. The coffee chain's largest market outside of America. It's opened thousands of stores over the past few years, 5 or 6 years. More than half of their stores have been closed for more than a week. And more important, you have to understand it's not just, these companies have revenue exposure. This has management from Starbucks said even the stores that are open, they're having trouble getting those menu items because a lot of that stuff is produced in China and everything's closed. So they can't even get the menu items or serve everything on their menu for the stores that remain open in China. Tesla, the best stock in the world. Everybody loves Tesla. Tesla just watched a stock soar close to 100% this year. Guys, we're in February. It was based on what? Strong earnings in its most recent quarter and its huge growth potential. And that outlook included strong growth from its new Shanghai Gigafactory, which Tesla delivered its first Model 3 on January 7th from that plant. The plant is closed right now. It's okay, though. Tesla's still going up. China's become the fastest and one of the largest growing markets for McDonald's. They plan to open another 1,500 new restaurants in the years ahead. Right now, 300 of those restaurants are closed. McDonald's CEO says, and due to coronavirus, said China is a critical market for us, and we're very concerned about the situation over there. That's what they said in their last conference call. Yet, the fast food giant, guess what? Guess where it's trading? Near all-time highs. So I've been covering this story for the past 2 weeks. And this is just a few of the many companies that are worried about the potential risks, right? Even though they're trading at highs and the management teams are telling you that we may see material impact. I mean, Carnival just warned and said that they're going to take at least a 65-cent hit to earnings. That's a 15% hit this year. It's going to be much worse than that. I mean, it's going to be much worse than that, especially for Carnival. You think that anyone's really going to go on a Carnival cruise? You really, I mean, at least over the next 6 to 9 months, there's no way. There's no way. I mean, you have to think of emotional times. You have to think like after September 11th. I mean, even me, after September 11th happened, I was looking up in the sky like the next couple of weeks to see if there was a plane that it might crash into something. I mean, the emotions are so high during these things. You're telling 400 million people to stay home. You have stories all over that people have been on that cruise for a week and locked in their rooms. They can't even get out. And only certain people could go into certain spots. I mean, you know how crazy you think I'm going to go on a cruise? Who's going to go on a cruise? It's insane. Who's going to travel? Who's going to go to China over the next 6 to 9 months? You're going to go to China? I mean, for me, I would go. I mean, if I get infected, again, I look at this as like having the flu. But a lot of people don't think like me. A lot of people are nervous. They don't want to go. But again, surprisingly, the markets don't care. They're bidding up these names to new highs. And you have to understand that China is a growth engine of the world. And everybody's focusing on China. But the effects are starting to pour out to other countries. Why? Because China's responsible for the supply chains. So you're not going to see it show up in revenue. They may make everything there, ship it to them, and then they sell it every place. So a lot of people will say, well, these stocks have exposure to revenue. These stocks have exposure. It's not just revenue. It's not just profits. Take a nice drink of water because I keep going here. Usually I have an interview in the middle of this. That gives me a little bit of a break. But I got a lot to talk about today. But you look at other countries. I mean, there's a bath furnishing seller in New Zealand. They manufacture shower heads, very, very big, and those are made in Shanghai. Plant's closed now. It's telling its clients, sorry, we can't service you. Hyundai halted their operations in South Korea, not China, in South Korea. You know why? Because they have a part shortage because of China. That's a pretty big deal, closing down your operations in South Korea, considering 37% of Hyundai's cars are manufactured in South Korea. It's shut down right now. It's okay, though. Nobody cares. It's fine. It's going to come back. That'll be fine. Saudi Arabia putting together an emergency OPEC meeting to address oil demand concerns. Why? Because China is one of the largest oil consumers. Again, a lot of this is turned off. These people depend on that oil being used, those barrels being used. That's why they report barrels per day, because that's how much oil is used. Well, we're on a week now. Some businesses are starting to come back. A few people are starting to go back to work. But even if you look at the electricity markets and the statistics, which I researched, all gone down in China. If you're looking at the smog indicators, even those has gone down in Beijing because there's no factories. Nothing's turned on. And that's the best indicator. You can't fake that. So you can say, well, China is lying about the numbers, and you may say, well, what happens if China continues lying about the numbers? It doesn't matter because it's going to show up in the earnings reports. And that's what's important, because right now it's fine. We just reported earnings. Next quarter, watch out. And I have to tell you, it's not just going to be one quarter. I mean, do you really think, use your common sense, that you're going to get a phone call? Hey, everything's okay. Come back to work. You're fine. And you think everybody's going to run to work immediately? And I'm not too sure if there's someone that knows the laws better in China, but Wynn said they're taking a $2.5 million hit every single day that it's closed. Their casinos are closed. And they're paying those workers over that time. So, which I find amazed, because I thought you had to go to work to get paid like in America, right? I guess you can make your salary or whatever and you're on fixed salaries. But, you know, if you're not going to go to work for 2 to 3 weeks, you would think that, you know, maybe you can cut that, but they're still paying them and paying them and paying them. Not only that, are you going to go to a Wynn casino anytime soon? Are you going to go to Macau anytime soon? I mean, think about that for a minute. Casinos, really? Have you seen the people that play slot machines? I'm not putting anybody down. I like slot machines too. But man, just smoking and just touching everything, you know, the hand. I mean, man, if it's going to spread, that's the place. You're really going to run to the casino like in like 3, 4, 5 months, be like, yeah, everything's okay? No. But I think you just quarantine 400 million people. And remember, these events are taking place right now, and the coronavirus is not close to being contained. I don't care what they say. It's not even close to being contained. If it was, they'd open up all the stores. They'd be perfectly fine. It's not. If you listen to the leading doctors out there, they're all, again, that's not the story. People just, hey, everything's okay. The market's okay. We always rebound, buy the dips. I've been telling you to buy the dips like crazy. It's different now. It's different now. And when I look at what's going, just with China changing their rules, that if you get tested positive for the virus and don't show symptoms, then you're not infected. But yet they're a carrier of the coronavirus, and they can affect so many people. So when I look at the markets, and I want to be clear on this, guys, I'm not telling you to sell all your stocks. I'm not calling for a 30% crash in the S&P 500. What I am saying is there's numerous companies with exposure to China that are going to fall sharply over the next 2 quarters, especially ones who are strongly dependent on China for growth. It's not going to be difficult to find those companies. You could do Google searches. I have a lot of them. I'm going to list a lot of them in my newsletter, which is Curzio Research Advisory. It's a 16-page report. If you want it, go to my website, curzioresearch.com. It's $49 for the year. The money you put to fill up your tank of gas for your car, right? And if you're a first-time listener and think I'm trying to sell you something, then buy it and then cancel it because it's a 30-day money-back guarantee. But trust me, when you buy it, you're not going to cancel. When you see the statistics and you understand that I understand growth stocks, I understand value stocks, I understand we're in a growth market. My portfolios are based on being in a growth market. That's why I was trying to sell a few things to lower our risk here. But we're in a growth market, and you deserve high multiples when everything is going right. And now China accounts for 39% of the global growth last year, and it's turned off. And everybody thinks that's not going to be a big deal, and they're wrong. Even the companies are telling us it's going to be a big deal, and people don't care, and they're buying stocks right now. That's very, very dangerous. The last thing I want is all the money that you made over the past how many years goes down by 20% because you own the wrong stocks. Because a lot of that work is a waste. You want to protect your assets. There's times to go all in, and there's times to be cautious. You have to be cautious right now. I don't say that often. I don't. But doing the research on this, it's crazy. I mean, if you're seeing companies with exposure to China, again, they're going to fall sharply. Those estimates are going to be cut. And what people are anticipating that they're going to be cut and then come back. That's not necessarily the case. And let's take Starbucks, for example. I mean, Starbucks is not going to do business in the 2,000 plus stores that they close. Does that mean when they reopen that people are going to buy twice as much coffee? They're probably drinking whatever kind of coffee right now at home. That doesn't taste as good. They're not going to like double up their purchases when they come back. That's revenue and earnings that are lost. You're looking at when this happened, because this is important. Because speaking of China, the coronavirus could not have come at its worst time. GDP growth was already at a 30-year low. The whole trade war thing with the U.S. over the past 2 years, and I said, listen, the sentiment, it's positive sentiment, that's a big deal. Only a little has been done. That's hurt them. The major protests in Hong Kong, where residents fighting for the independence against the mainland, all this stuff taking place. China's market rebound in 2019. Why? Trade wars, those fears eased. However, during that time, you have to realize a lot of companies removed some or all of their supply chains out of China to lower that risk, that uncertainty of another trade war happening, Trump sending tweets about different industries that are going to get taxed, tariffs. You can't operate a business like that. If you have 30, 40% of your supply chain in China, you're getting all those goods, and now all of a sudden they're going to cost 30% more to produce. You got to limit that risk. Otherwise, you can't operate a business without trying to predict the future, and you can't. No one can predict the future, but you could predict how much you plan to spend. And if you're generating more money, we spend a little bit more on advertising. Again, you want to forecast. You can't even come close to forecasting. That's too big of a risk. So a lot of them were removing the supply chains out of China, which already hurt that country. But again, it rebounded off of lows. But right now, most of China is completely shut down. Businesses are closed. Factories are barely running, maybe at 15% capacity. And this trend is likely to continue well through 2020. Again, it's not like a light switch. You're going to go back to full production. Okay, it's like you open up a big gate and 400 million people come out and just run around and go to work. No, it's not like that. They think they're going to be like, wait a minute, I don't know if I should. And all you need, because again, you're going to see more. If they do that, you're going to see more people get infected and make more people nervous. I mean, with SARS, again, infected just 8,000 people, 9 months to contain. There's over 40,000, if you believe the numbers, which I think they're at least 10 times higher. 400 million people on lockdown. I mean, again, even if businesses start to come back online, you don't see a lot of these people travel long distance to go back to work. I just don't see it. So you're looking at the impact on China's economy, and that negative impact, it can't be understated. Not only that, I'm going to throw something else at you, which, to mention in the news a little bit, this is happening at the worst time. I mean, Chinese New Year, which spans from January 21st to February 20th, right in the middle of this, shut down. Last year, consumers spent $150 billion over this time. Again, that's money that could be lost. Are you going to spend it after that period? I don't know. Maybe. I don't know. But nobody's traveling. Nobody's doing anything. They took CNBC that reports, even from people in Chinatown, saying their business is down 80%. Nobody's traveling. And this is, New York City Chinatowns and San Francisco Chinatowns. Nope, they said they can't get their goods. Nobody's traveling, and it's down tremendously. And you would think, wow, that's not China. That's someplace else. But it just goes to show you that what they're reporting on TV and what you're seeing from what companies are saying and what they're going to report, it's going to be a lot different. And it's definitely not priced into the market. Doesn't mean you have to sell all your stocks and go crazy, but you have to position yourself appropriately. Because when you look at China, people who are bullish on China are crazy right now. They're crazy. I mean, if it was so good, you have China the government injecting money. You also have, which people say, well, that's a good thing. That could push up the markets. But no, it's a bad thing. It means things are worse than expected. You have the biggest companies are allowed to refinance their loans that are due in 2020. They're also providing more loans for a lot of businesses because they're shut down. So a lot's going on. For me, I think the GD estimates could fall to 3% in 2020, not the 5.5% they're reporting. And under that scenario, most China stocks are going to get crushed, especially considering the Shanghai Index is actually up 11% this year. Crazy when you think about it. So be very, very careful. Position your portfolio correctly. If you're a Curzio Research Advisory member, you're going to get an amazing report showing the stocks that you should avoid. I have 2 recommendations because of this. One is a large cap stock that's going to surprise you. And the other one is, I won't tell you because it's a very, very important play. But the point of this podcast is not to scare the shit out of you. Okay. It's not what I'm here for. I'm here for you because there's times to be bullish and there's times not to be. And right now is a time to be cautious. And you know what? If you're listening to this and you're saying, that Curzio guy's an idiot. He doesn't understand. Everybody else has it right. He has it wrong. You know what's going to happen in your portfolio? Not too much. You're still going to have long exposure. We have long exposure in both of our newsletters. both of my newsletters. And those stocks are going to go higher if this isn't a big deal. But if it is a big deal, you're going to save yourself a lot of money and a lot of pain. And that's why it's important. Okay, you have to be concerned with this risk. This is a very, very serious risk. It's one of the first major risks I've seen for a reason to sell stocks, and nobody's really selling them. They sold them for a week, and now like everything's going to be okay, just like in SARS when China was 4% of the economy. Now it's 17% of the economy. China, if I had to guess, accounted for maybe 10, 15% of the global growth back then. It's 37%, 38%, whatever I said before. Unbelievable. That accounted for the global growth. That's a growth component for a lot of these stocks. So be very, very, very careful. If you want to read my report, CRA, if you're a Curzio Research Advisor member, you're going to get it tonight. And if not, you can go to my website and subscribe to it. Again, it's $49 for an entire year. I have a feeling you're going to save a lot of money. Even though I'm not supposed to say that because past results don't guarantee future results, I'm telling you, just read it. Okay, it's worth it. And if you think I'm full of shit, you can cancel and just get your money back. This isn't about the money. This is about you. You guys know I care about you. That's why I listen to this podcast. This is something that's very, very serious that a lot of people are dismissing, a lot of investors are dismissing, and I think that's going to be a very, very big mistake. And the good news is, if I'm wrong, it's not really going to cost you a lot. But if I'm right, you're going to be well-positioned, and you're going to be able to hold on to a lot of those profits you generated over the past 5-6 years. Whew, what a podcast. Hopefully you guys weren't sick of me talking the whole entire time. But it was very important. You don't see me sound the alarm like that a lot. And this is something that really scared me. That's why I seriously, Tuesday, guys, I had no idea. I was like, holy shit, I need a guest. And I was like, you know what? I can't have a guest in the middle of this. It's just not going to, it's going to take it away. And it's too important of a message. So I said, let me just do this. No guest today, no nothing. So Dollar Stock Club, you're not going to get a pick this week. It's okay. You get 52 picks. You usually get a pick every single week. You're not going to get one this week because these picks are going to be reserved for the Curzio Research Advisory member, which, again, there's 2 picks. And it's the first time I probably recommended 2 picks in that newsletter in, I want to say, wow, at least 2 years. So, again, Curzio Research Advisory, you'll get that coronavirus special report today after the close. So, guys, that's it for me. Any questions, comments? I know there's probably going to be a lot after this podcast. Just email at frank@curzioresearch.com. That's frank@curzioresearch.com. And I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.